Hello folks, this is Scott Bruce from Integrity Wealth Consulting with a February 2016 Educational Economic Update. In this video, we'll talk about some of the economic headlines that influenced markets in the last month and give you some insight into what they could mean for you as an investor. Please stay tuned at the end for the required disclosure statement. January was another volatile month for stocks. Investor sentiment turned negative on more bad news out of China and plummeting oil prices. Let's talk about some of the month's major headlines. A first look at fourth quarter economic growth showed us that the economy hit a soft patch in the final months of 2015. Gross domestic product grew just 0.7%, which is a disappointing drop from the 2% we saw in the third quarter. Q4 GDP growth will be revised 2 more times as data comes in, and it's possible that the final result will be more optimistic. However, we're not expecting a ton of improvement. Why did the economy slow down? We can attribute a lot of it to the drop to lower business spending and weak global demand. However, the data also shows that U.S. consumers aren't spending the extra money they save from gasoline. Does the slowdown mean the U.S. is heading for a recession? Probably not. It's not great news, but the economy went into negative territory back in the first quarter of 2014 and bounced back rapidly. In other news, the Federal Reserve met in the last week of January and declined to raise interest rates again. That's not a big surprise given the challenging economic and market conditions, but some experts don't think that the Fed made the right call. With so much uncertainty in the markets, a rate hike could have given investors more confidence in the economy. On the other hand, inflation remains low and economic growth is modest, so the Fed might hold off on further rate increases for months. Earnings seasons kicked off in January, and the overall picture is one of lower earnings and lower revenues. That's not a surprise because we know that American firms are facing major challenges from a slowing global economy, a strong U.S. dollar, and weak commodity prices. But more than 2/3 of the firms that have reported so far have been able to beat their earnings targets, which tells us that the managers are doing a good job of managing expectations. On the positive side, a gauge of manufacturing activity blew away expectations and came in at the highest reading since last January. Manufacturing, a backbone of economic activity in many parts of the U.S., seemed frozen after several reports showed that factories struggled with demand. This new data is refreshing change, and we're hopeful about manufacturing this year. That's it for the February Educational Economic Update. Please remember that nothing we talk about here is a recommendation. If you have any questions or concerns about what we've discussed, please give our office a call at the number below. Once again, this is Scott Bruce with Integrity Wealth Consulting. While we believe the information in this report is reliable, we cannot guarantee its accuracy. Opinions expressed are subject to change without notice and are not intended as investment advice or solicitation for the purchase or sale of any security. Please consult your financial professional before making any investment decision.